Hey everyone, welcome to the Wise Wall Show. Mike Rosehart here. Just getting set up. Give it a minute to catch up. See if we're live. Health stream is live, so we are good to go. Okay, there we go. If someone has jumped on, please let me know that you jumped on. Simone, I see you on there looking spiffy, Mike. Appreciate that. Thank you so much. Hope all has been well. All has been well, yes. So we are live for the Wise Wall Show. As people jump in, just take a minute, let everyone get the notification and jump on. For those people who are joining on the replay, thank you so much for tuning in. I always appreciate when you jump in the comments and say, hey, you got some value from episode 26 or whatever episode we're on. Today's episode 26. Hey, Jared, how you doing? Good to see you on. A lot of the regulars waiting for them for a minute to pop on. Today's a really cool day, actually. I spent the better part of my day at the Richard Ivey School of Business, which is where I graduated from, University of Western Ontario. They did a case called the Roseharts, Part A and then Part B, and there was a live component to Part B where they basically updated my wealth plan and sort of how to build a really good wealth plan over the 5-year period from when I wrote that plan to what I was able to actually achieve based on following some of the goals and things that I set out in the plan. It was interesting to see how things unfolded because I obviously did much better than I had expected. And so it was kind of a bit of a surprise for people. And hey, Brian, how you doing? So I think people got a lot of value from basically from that. I got a lot of value from it at least. I know the interaction afterwards, the Q&A. Oh, this isn't pinned. It's just sitting here on the table. My bad. Is that better? It's probably a little quiet. I can put some audio gain on if that helps people a little bit. Is that better? Tell me if this is nice and loud and clear. I just turned it up at just a tad so we can see if I'm getting the right decibels here. I can't hear the replay, so I don't know whether or not it sounds good. You guys have to tell me what's good. Edward Smith, the Smith brothers are here. Cool. Great to have you guys on. Hugo, hi Mike. Sorry I can't really help in London because of commute over, but more than willing to commit some financial resources. Cool. Yeah, I did get a message. I'm getting a few DMs. I promise to get back to you there. If there's a way we can partner on a deal or something, that's what it's all about. We just got our website up, so check this out. I type it in here so people can see. We worked all night. We were up very late last night, and I got up super early this morning. There's our website, www.rwholdings.ca. Ignore the pictures. There's some really bad placeholder pictures. I don't know why he put a picture of me with my mouth full of food on a vacation trip we did way out west. I was exhausted that day. Not a becoming picture. We'll definitely be getting some real pictures up there. It's just a placeholder for now. We've got a couple of deals we put up there really quick. What we want to put up, I've done 46 deals since 2012, so I want to get 46 properties up there in London, Ontario. And I really want to focus on the date I acquired them, especially the more recent 25 we've acquired this year, because people are saying you can't get cash flow in London. What about Windsor? What about Chatham? What about Sarnia? Let's talk about other markets and some of the risks, I think, of investing in less diverse, less economically stable markets. So for instance, Owen, in the news, might as well talk about it because we're talking about London and we're talking about local geography. And by the way, I apologize for this. I've got the smoother filter, so you probably can't even see it, but I'm growing this little Movember mustache support for men's health. So if you guys see that, yes, Jared, I was a guest speaker at my old school where I went. They did a case, and it's the case study method. So it was really cool to be able to give back and help the students with hopefully their financial plans going forward in the future. I love giving back. It feels really good. That's why I started this whole business in general. That's why Right Way Management exists in the first place. And that's why YouTube exists in the first place, is I tried to be a financial planner earlier this year, and that didn't really jive with who I am being, having to go into work at 8 o'clock in the morning. That just wasn't me. Having to peddle mutual funds, just not me. So I had to break free from that, and I'm thinking to myself, how do I give back to people? There's so much regulation in this industry, but what you say, what you do, that you can actually have an impact and help people. YouTube, that's the way you can actually help people. So that's been my mission, to help people unlock fire. And I love giving back and teaching about financial literacy. And that's what this is about. At a basic level, we could talk about income statements and balance sheets and how do you calculate rental income profit, or what do you do with your investments? How do you invest? All of these types of things. And then it came into a point where friends were messaging me and acquaintances reaching out and saying, Mike, you're getting insane returns in real estate. People just don't do this. People in London don't even get these kinds of returns. You're getting double what normal people are getting. What are you doing differently? And can I get a piece of that? Can I partner?
And so we just started buying properties together in joint venture partnerships until we had to formalize something and started a couple of companies. So I have a contracting company, basically a property management investment firm company. And really the goal of the company is so my investors get the chance to become financially independent. We get them 5, 6, 7 properties, and most of our investors are financially independent. So that's sort of been the drive, is like helping other people retire early, and in a modern sense, a modern retirement. So anyway, we're gonna work on that website. It just first is live now, so it needs obviously some work. But someone actually reached out to me and said, like, Mike, what are you doing? You're doing this video where you sold 11 of your properties off, you raised all of this cash, and you were going to be done and retire. Why are you going back to work? You didn't like having rental properties. And it was because I didn't have the right systems in place. I had some bad property managers and didn't get a chance really and truthfully to systematize the business. And so I've been trying to apply the systematized process to the business. So I'm not physically managing a lot of the properties. Some management, mostly managing people that manage the properties. We bring on maintenance people that can handle a lot of the workload back and forth with, tenants and property management, and renovating was a big one. It was just getting my hands dirty, changing toilets and things like that. I shouldn't be doing that anymore, and I don't do that anymore. So I put down the hammer and put a rule out. I am not going to do that. And so just a firm line in the sand where I just won't do those things. So it's sort of been interesting in the sense that making Michael Chung, I see that. What happened to the goatee? Yeah, I shaved it off. It was just too itchy. I couldn't handle it. But I have to leave the mustache because it's November. So that's the minimum for November that you can leave. So I left the minimum. Happy to be on here. Happy to have some people join me today. If you're lurking here watching the show, join me in the comments and just say hey. It's good to see who's on. I can't see who's on right now from the screen that I'm streaming from this computer. And if the sound quality is having any issues, feel free to jump in and let me know. If you guys can't hear something, I can change it up or down and adjust accordingly. And of course, as always, throw in your questions. I'd love to answer those. We're going to do a power hour of questions. Usually I let the questions build up a little bit, and then we end it off. So what I was talking about was why I do what I do, because it's very important to understand why someone does what they do. I talk on this channel a lot about just growing that $1 billion company. And that is cool. And that is something that probably will happen as a result of our real why, right? That'll be like a what. I already know how we're doing it. But I think at the end of the day, to build this $1 billion company, you have to be really motivated by something. And for me, it's helping other people unlock financial independence. That's just my thing. So I align all of this to help people unlock better returns they could get otherwise, right? So a lot of that means that I have to build a huge company, because there's a lot of people out there who need financial help and who need to create cash flow for their families and for themselves to unlock financial independence. And I think real estate is one of the best ways to do that. I also personally believe that managing a bunch of properties is a real pain. It's a lot of work to change out tenants. It's a lot of work to be dealing with like a toilet clog at midnight, or dealing with a roof leak, or dealing with all these different individual problems that go along with property ownership. And that's not really retirement. If you have a portfolio of real estate, it's not really retirement if you're doing the work yourself. So that's why I'm trying to build these systems, so that none of us have to actually do the work associated. We can build a company that will run with employees and systems in place. And that's what I wanted. When I sold my 11 properties, I wish I would have kept the 17 in hindsight, right? Because the market appreciated it and it's done very well. I would have kept everything if I had known that I had the energy that I have now and the partner that I have now, because that was a big thing. My partner at the time gave me a lot of that, a lot of what I was missing, a lot of the energy that I didn't have in certain focus areas, and he took that burden, and we are working together to collaborate on something, and it feels way better than being solo. I could never do this business by myself. I mean, physically I could do it, but I just would never want to do it by myself. And so I'm really thankful for the team, and I'm actually looking to do some strategic partnerships with some really cool people, and that's going to help us grow in a big way. I'd rather have a smaller percentage of a huge company with a lot of resources and power than to get things done, to really move the needle forward, than to be just a small shop and trying to have control. Because it's not about greed, right? At the end of the day, you got to share in the profits. That's why I joint venture. I could be buying these properties by myself and just borrowing hard money debt at 6%. I don't do that mostly because I want to share in the profit with other people. It feels good to make other people money, and so that's part of it. And there's more than enough money to go around, so why don't we just all share in that, and we can all benefit and build something really cool together. So that's been a big thing for me, and yeah, it's been really cool to help people unlock their financial independence. When they call me up and they say, Mike, I've saved $400,000 or $500,000, I could never retire on that. And I'm like, wait, you have a great job. Yes, you could. You could control if you think about it, you control about $2 million in real estate with 400,000, $2.5 million with 500,000, right? Because you can lever 5 to 1 with 20% down. So these people don't realize they've got these savings that aren't doing that much for them. They said, I'm getting 15,000 in passive income. It's not enough. I need more. And so real estate can provide you with basically a higher safe withdrawal rate. So this traditional 4% safe withdrawal rate, which basically just means that you can withdraw 4% from a portfolio in perpetuity and leave in inflation in the portfolio, right? So if people have $1 million in a portfolio, they can withdraw $40,000 a year forever, leaving in about $20,000 a year, or 2% for inflation. So the buying power will continue to increase over time, and you never need to erode the principal of your investment. So that 4% rule goes out the window when you're using levered, strongly cash flowing real estate. You can withdraw 8%, 12% I've seen models, and still sustain the portfolio, right? And still be getting ahead with mortgage pay down. So people are still actually building their net worth up, even though they're withdrawing these large amounts, because real estate returns such great cash on cash when you used a levered approach with cheap debt. So that's where kind of the real estate thing came from. Is like the reason we get better returns is because we can borrow so cheaply. And that's why I partner with people, because everyone can get 5 to 10 mortgages, up to 10 with Scotiabank at really cheap financing costs. And that's important because at the end of the day, nice, I see some comments here. I'm going to happily answer some of those in a sec here. It's just a beautiful thing because you can crank out an asset that returns 10% and you basically get the spread between what you're paying for your cost of debt, what you're borrowing at, and what the asset can return. So if a real estate property owned in cash could return 10% rate of return, that'd be great. That'd be a great target, I would say. With leverage, it should be able to return 40-something% return on investment, which is insane, before appreciation, before speculative investing, right? Just based on cash flow and arbitrage opportunities. So that's kind of where it's at. I don't want to flog like the invest with me or whatever. Like, if you want to invest with me, cool. If you don't, that's cool too. This channel is not about that. This channel is really, at the end of the day, about helping you learn about financial independence, the FIRE community, the FIRE movement. I'm out here at the forefront of the FIRE movement, trying to share that there's this idea that 90%, 95% probably of people don't realize that you don't have to work until you're 65, 67 years old and then basically have a few years to enjoy your life and die. You can have a modern retirement where your passive income covers all of your living expenses and you don't need to work. 77% of people are unhappy. I'm going to keep flogging that Gallup study that talks about people being dissatisfied in the work that they do. Most people don't enjoy what they do. And if you do enjoy what you do, cool. That could change. Be prepared in case your industry changes. Let's look at Windsor. You heard about what's happening to GM. They closed the Oshawa plant. GM's making some strategic cutbacks. That is very bad for a town like Windsor. Windsor relies heavily on manufacturing. So that's an example of Sarnia too. Sarnia is very tied to the chemical valley, to the petrochemical industry. If that were to ever be cut, Sarnia is basically gone. The prospects of viability of being able to rent there are almost gone. There's a negative population growth in Sarnia, for instance. London, Ontario, on the other hand, is a very diverse market with 70,000 students as opposed to about 14 or 15,000 in a smaller town like Windsor. And in Sarnia, you'd have about a couple thousand students. So it's much less diverse. You don't have the financial markets that you have in London. You don't have, like, we have manufacturing, we have education, we have healthcare. There's just so many different industries within London, tech, military. There are a lot of different facets of London's market that if we lost any one category, like and I keep talking about this, but you guys remember that Maple Leaf's opening a plant. They announced that this week. I got some calls about that. That's pretty sweet. 1,500 good paying jobs to London. That's a huge boost. Anywhere around the Maple Leaf plant, if you're looking kind of in what is it, southeast London, if you have properties in the Highbury and Hamilton area, kind of all in there, those should all benefit from the new Maple Leaf plant hiring 1,500 jobs. I really hope that comes to fruition. I think that'd be really, really cool to see see things kind of change. Jake, awesome. Hey, Mike, I'm closing on my first deal on Friday. It's a house hack triplex. Wanted to thank you for answering my questions the last few months. Thanks so much. Jake Wing, that's awesome, man. That's fantastic. Nova Scotia, sweet. When I was actually in Newfoundland doing my realtor exam there, it was met some really cool people there too. And there's so many people across the provinces, across Canada, and across the world who are crushing in their markets. And so that's amazing. House hacking is the best. I also house hack. I love it. It's fantastic. If you can share the cost of your living situation such that it becomes near zero through either house hacking or rent hacking, I mean, can't beat that. I was talking to the students today in class, at Ivy about some of them are from Toronto and Vancouver and don't want to live in a smaller market. And they're like, well, your house tax thing doesn't apply to me. There's no way I can get a house in Toronto or Vancouver. And I'm like, what about rent hacking? What if you were to rent a place and Airbnb parts of it, or rent a place that you can kind of use IKEA bookshelves to convert into another bedroom and rent those extra bedrooms out so you can reduce your living costs and your rent to near zero, living in the smallest room for yourself. I know people in Toronto and Vancouver who do that, get their living costs way, way down. So you're in control of what you spend. You're in control of how you get value for the dollars you put out. You could put $100 towards groceries and get $100 worth of food, or you can put $100 out in groceries, use the Flip app, price match, and get $200 or $300 in food. So it's all about how you use those dollars and use them really important. Like hold on to every dollar. And you guys know I talk about dollars like minions. And I think every single dollar I have is a minion that I need to put to work. And if it just sits in a savings account, it's not working for me. I want to basically put that money to work. And with real estate, you go take that, you put a minion up, and your ally, the bank, puts 4 minions up. So you have 5 minions total out there fighting for your cause, and you only had to send 1 military man. That's a strategic, smart alliance. If we're looking at this as like a military example or a minion example, and all your dollars are out there working for you. And once you have enough of those dollars working for you, why are you even working yourself? You're better off being a general in your own army and making sure your military is being deployed strategically to the best optimization that is possible, right? So you can have that multiply and grow, and basically have your army working for you so you can enjoy your life. So that's what it's all about at the end of the day. Yeah, that's awesome. I'm curious to hear more details about the triplexes need renovation. What are you going to do with that, Jake? Happy to share if I can have any impact, answer any questions, any insights. Happy to share. Michael Chung, what do you do when tenants crank up the heat during the winter? Yeah, so that's a realistic, actual, I think, problem. Tenants are very, very bad with utility management. One thing you can do is, even if your tenants are getting an all-inclusive of utilities rent, you could say up to a maximum. So I often will say, I include hydro and water up to a maximum of $100 a month for hydro and $50 a month for water and $50 a month for gas. If you go above this usage, this is more than what a normal tenant would use for this unit based on historicals, and therefore I'm going to bill you that. So it's all inclusive up to an amount. You can put that right in the lease, up to all inclusive up to a certain amount. The other option too is some people just split the utilities right up and duplexes that aren't separately metered. They just say the upper unit's 3-bedroom, lower unit's 2-bedroom. I'm going to say you pay 60% of all the utilities, you pay 40% of all the utilities. That's what it is. Sorry, bucko. And tenants take that. Then, of course, the last option is make the tenants pay all the utilities. And I have lots of houses where this is possible. If it's one family in a house or one group of 5 people or 5 students in a house, you can make them pay utilities. And so they pay hydro, gas, water. And you don't really care how they turn the heat up. It's mostly when you're concerned about supplying the heat to the building where you'd be a little concerned. And there are some strategic decisions you can make to better things, like Nest thermostats are fantastic. You can watch and monitor what the heat is wirelessly. So that's something great I've been putting in some properties when I get the chance. I'm not out there splurging on them, but if I'm upgrading a furnace and there's a good opportunity to put one in at 50 extra bucks or something, that's when it can make some sense to put one in, and you can monitor and track. I like to program. Most thermostats are $20, $30 are programmable. So I like to program my thermostats. Even if the tenant touches it, it'll automatically revert back to the program on them. And they have to really spend the time to program it otherwise. Cool thing too is get a house hen. I usually will pick someone who's like the house hen and tell them to watch the heat, and they're kind of that person that's fighting for you in the property. So that's something you could do too. At the end of the day, spend some money on insulation. It's a great return on investment. Insulating attics, I tried to insulate the attics in most of my properties, mostly because you can spend $500 to $700 to insulate an attic from this much insulation to this much, and your ROI is triple digit, almost 100% return on investment just by investing in something called insulation. So insulate really well. Houses in the 70s, 80s, and 90s were not even built with the code that is today of R60 in an attic. So like a lot of attics today have over a foot of insulation, has a huge impact on basically your heating bills. So if you can get a good return on investment on that, that's important. Mr. Money Mustache, great blog, MrMoneyMustache.com. He did an article on insulation and how you should be investing potentially in insulation. So that's kind of a cool way to think about it. If you own a house, maybe you should be investing in insulation instead of maybe stocks or bonds. You get a better return investing in your actual heating bills. Okay, let's go up here and crack some questions. Here we go. Rapid fire. Wisewell Show. Okay. You guys are talking about that. Robert Moritz, he says, yo, Mike, you getting into apartment buildings anytime soon? Robert, good question. I think that if I get tapped by a really wealthy investor who has so much capital that I can't find them enough deals to satiate their hunger, we'd look to commercial property. The problem with commercial property is you're competing with institutional investors and institutional money. And institutional money has lower standards. Big institutional money can't buy a portfolio of single family properties. It's just not allowed. Like if Sun Life has $1 billion to park with a REIT, they'll say buy commercial property. I don't know why this is, but they just consider it risky to have a bunch of residential duplexes and triplexes. They just don't like it. I don't know why. It's just like most funds have those requirements. Most banks consider any like commercial lending, they want to basically charge you a higher interest rate. So anyway, long story short, a lot of commercial changes hands outside of the MLS, outside of what you're seeing, right? It's a lot of people who know people, and that's how most commercial deals happen. And you're competing against institutional money, so the competition is fierce for these apartment buildings, and they sell like 6 and 7 cap rates often, which isn't as good as the 12 or 14 caps I'm getting on single family duplex and triplex. So the arbitrage opportunity is way bigger, focusing in the 4 units or less, 10 bedrooms, 12 bedrooms or less. I've been getting a lot of exposure there for arbitrage. Now I'm getting a deal a week right now. If you told me, someone came to me and said, Mike, here's $10 million. I love what you're doing. If you can double this for me in the next year, get me 30% return on investment, like whatever. Maybe they've got a property or two with me now. They start to trust me, start to understand what I'm doing. And that's what I recommend. Get a property or two and go from there and see how we do. But let's say that was the case, right? I was tasked with spending $10 million. 10 million levered up would be like 30 million. That's a lot of single family duplex, triplex, fourplex type properties. I probably couldn't buy enough unicorn properties like that. I would have to get into commercial. I would have to start finding apartment building deals to satiate that hunger. And basically I have to get better connected. And that's why I'm getting the real estate license. I'm gonna be focused on commercial real estate. Basically it's a lot of networking, honestly. That's where you start finding the people who own a lot of the apartment buildings. And some of them are getting old, or baby boomers in their 60s and 70s. They're getting ready to retire. And they don't want to deal with this apartment building anymore. Maybe they have a bad property manager, bad superintendent. There's opportunities for efficiency there, and you can make a ton of money in apartment building cleanup, like cleaning up bad tenants, getting the rents changed over, especially because rents have jumped 25% in London. There is a ton of opportunity there, but I need investors that have a lot more capital to be able to jump on these types of deals and set up. I probably have some investors now that have the capital that could jump on that, but right now I've just been farming the single family duplex, triplex, that kind of thing. I will eventually get into the commercial stuff. It's going to happen. It's inevitable. So great question. Am I getting into it? Yes. If something comes on the market, there was a 15-unit building we offered on, would have been a great apartment building. 3 of the units were vacant and kicked in by the police. There was a ton of opportunity on this property, but I think they wanted a little too much for it. We didn't offer. It went over asking. It was just crazy. There's tons of money from Toronto bidding up the prices still on those types of buildings. So it would have to be an off-market deal, I think, would be the key to really making me getting in. What news source do you use? Honestly, Michael Chung, I don't spend a lot of time really on the news. My news source comes mostly from just people talking to me. Facebook, I'm pretty in tune in my news feed. They'll share what's going on in my local economy. Instagram too, I follow some people and some trending hashtags that would show me what's going on in the local market. And then of course a little bit of YouTube, I'll pick up what people are talking about. So that's my source of news, honestly. I don't have time to be just digesting all this news. It's too much, and you shouldn't be trading just on market speculation anyway. So it doesn't really matter what the economy does in the short term. The most important thing I think to realize is that if you've got good long-term fundamentals, that's the key thing. A lot of people are focused on, like in 2008, they're focused on the news right all the time. And you should just be investing for the long term. If your dollar cost averaging by 2012, you're back up. Who cares what happened in 2008? The news was very dark and doom and gloom because that sold papers and magazines. But at the end of the day, it doesn't really matter as much as people think it does. And people care too much about the news. I mean, it's good to know what's going on. Like this Maple Leaf plant's bringing 1,500 jobs. That's a good thing. You could check out, if you're interested in London Free Press, check out I get a little email notification. I'll check out like the couple of big articles that drop on occasion. Now, I don't always keep up with that, but I try to. So yeah, that's definitely one thing. Dollars and millions like that. Yeah, exactly. 100%. Please make a video on finding good investments. That's by far the biggest thing keeping me from pulling the trigger. Thanks a lot. So Snake Eyes 11. Yeah, finding a really good property is difficult. And I think every market is slightly different. And there's a lot of people in the industry that don't know what they're doing. A lot of mortgage brokers that don't know what they're doing. A lot of agents don't know what they're doing. And the problem is they dupe you into buying crap, because 8 out of 10 properties you don't want. That means 80% of landlords are not optimized, and that's okay. I mean, they're still making money. At the end of the day, getting into real estate in general or getting into investing is better than doing nothing. I think investing in the S&P 500 is better than sitting on cash, sitting on your hands saying, I'm not sure what to buy, I'm not sure what to invest in. Invest in something. Pick something diversified, pick something for the long term, not cryptocurrency or something that's risky or volatile. I'm talking being diversified and buying on like the S&P 500 is going to be here in 50 or 100 years, buying into exchange traded funds. Just pick some ETFs that are like globally diversified. That's really important. And if you have something in the market, then you can work on optimizing. Because I did the same thing. I had like 50 grand sitting at TFSA. I was too nervous to pull the trigger on any individual play. I was thinking the market was overvalued. What I should have done is just invested that capital. And the long term, I would have moved it around somewhere. But 6 months will go by when you're sitting in your hands thinking about stuff. Life gets busy. You're better to be invested in something than in cash. Because in cash, you're making a choice to invest in something you're going to lose money on for sure. Because inflation is going to eat away your cash. So by doing nothing, you've actually made a decision. And that's the worst decision of all, just keeping it in cash. At least keep it in a high interest savings account at 3% with like Scotiabank or Tangerine or one of those guys. That would be really, really important, I think. Amy Lee, you mentioned you're looking for investors. What qualities are you looking for? So typically an investor who can actually buy real estate. So I have people who reach out who have no money, who can't buy real estate, who have no jobs, they can't get a mortgage. You need to be able to get a mortgage, or we have to pair you with someone who can get a mortgage, which is even more difficult, but something we can do. Or you have a really good mortgage or a really good job, you make 100 grand a year and you have no money, we can pair you with someone who's got capital. That's not a problem. We can figure out a joint venture partnership that will actually work, where someone will bring the mortgage financing, someone will bring the capital to the deal, and someone else will bring the management and the actual deal. So we can work with that. But typically, Amy, the ideal investor for us is one that has like a good pile of cash, like 100 grand or something would be ideal. The best investor can close in cash, but doesn't, because the best deals I found need to be closed in cash. We got to renovate them a little bit, and then we slop a mortgage on them after at a way higher rate than we bought them for. Pull out all of the money. We do an 80% loan to value mortgage, pull out all the capital, and the investor gets all their money back. So the really rough deals that close quickly that need to close in cash, those are the best kind of deals. So if you want the best kind of return, you have enough cash to buy a property 200 grand or something, right? That would be ideal. Now, that doesn't mean we don't work with investors who have less. I've worked with investors that have $75,000. We buy a property, we're going to refinance it, try to get the capital out. They're getting a better return on their money than they would otherwise. And when they lever that money up, they can spend $50,000 and control $250,000 in real estate because they're levered with a bank mortgage. So that's something they consider. And the debt is self-serviced by the rental income. So it definitely can work. Yeah, I mean, at the end of the day, if someone can't invest with us, maybe there's a way they can work with our team to learn. Maybe they just watch the videos and learn and save up, because a good part of it is saving. People who love real estate, maybe they become a real estate agent. Maybe they work and become a wholesaler. There are opportunities to get invested in real estate. I know people who didn't have any capital who rented places out and then Airbnb'd them, right? So they went and rented like 3 places in Toronto, and then they Airbnb'd those places, or they re-rented those places on sublet and profited. They got control of a real estate asset, of $1 million asset for say $2,000 a month, which is crazy. You can control $1 million asset in Toronto or Vancouver for like $2 grand a month. That rent basically gives you full control, and then you can sublet that or do whatever you want with it, assuming your landlord's on board. Maybe you can work something out. Rent control is such that it's very hard to increase rent for a landlord, and it's really hard to evict a tenant. So you actually have the power as a tenant to do that, and people have been doing that with Airbnb especially, and it's been killer. Hey, Mr. Michael, how you doing? Michael Chung, do you wear gloves when you install and touch insulation? It depends on the insulation. So rock stall insulation is made from a rock wool material. And so rock wool is not near as bad. The particles aren't great to breathe in, probably. You should wear a mask. I really should be. Fiberglass insulation, you're talking about the pink, the white, or I guess there's yellow too. Fiberglass insulation is the most standard. And then there's cellulose insulation. And there's also spray foam insulation. And then there's old insulations like asbestos and stuff, which are really bad for you. Rule of thumb is you should wear gloves when you're touching insulation. I often touch it and don't have gloves on, but sometimes I do, and I try my best. Best practice, wear gloves. The fiberglass gets into your hands, Michael, and it's difficult to get out. It can be really itchy. I used to get it in my hands and stuff, and it would take a day or two to come out. It hurts getting those little pieces, little shards of glass in your hand. It's not going to kill you. You'd be fine probably, but it's definitely not good for you. It's like, smoking's not good for you. It's not going to kill you after one smoke, but not good for you. Probably should wear the safety equipment. Good question. Jonas, welcome on. Hey, how's it going? Good to see you on. You're one of the diehards, so I'm glad to see you jumped on. Brian Smith, how are your deals typically structured with investors? Thanks. Brian, so it depends on the deal. We take between, like the standard rule of thumb is, the standard industry is 50-50 partnership, right? Almost everyone's doing this in most every market, Fruitful Investor all the way to, guys all in like John and Windsor. I think the model that most people are using, a lot of people in Toronto I've talked to, people in Vancouver I've talked to are doing this 50-50 model. Even in the US, I've seen this 50-50 model be the most common model. And that's where you take 50% of appreciation upside, or some people do 50% ownership in the property, which is crazy. I would never do that much, but and then they do 50% of cash flow and they split that with the investor who brings the capital. The way I do it is not 50-50 model. I'm giving more back because I don't need it. Cash flow doesn't matter that much to me. So we've structured it with a company effectively where we get between 40 and 50% of appreciation above what is invested in the property. So if we buy a property for $200,000, we spend $20,000 renovating, and there's $5,000 in closing costs. Our cost base is now $225, not $200, and we sell it, let's say, for $300. There's really $100,000 more than what we bought it for, but when you factor in renovations and closing costs, there's really $75,000 of real true profit. We'll split that in a 40-60. So I'll get 40, the investor gets 60, or 50-50. Now, you might ask yourself, like, why would an investor pay that? Well, because an investor is going to buy a property at 300 worth 300. And when I bring them something at 200, they're so happy to be involved in this deal to get this arbitrage, this opportunity to create this value. It's a win-win when we can share that money. And the ROI, sometimes joint venturing, is higher than you get by buying by yourself and making the mistakes that we wouldn't make, right? And so that's sort of the allure of joint venturing, and why I've even joint ventured before. Friends of mine had deals under control, and I joint ventured with them. I provide the cap. I've been a money partner on joint venture deals where I didn't have control of the deal. The deal is everything. People say the deal isn't important. The deal is everything, and the management is everything. So if you have really good management, you can turn a property around, make it really profitable, putting in the right tenants, managing things with way lower costs. There are just, management and deal are so much more valuable than people give them credit for. Check out the videos I did on how to structure a joint venture partnership. And I think it was like the second part of that was financing, the people management, all the management, and then the actual deal. And I talked about the different three elements in a joint venture partnership and where the value comes in play. If I'm bringing you a market value deal that's not a screaming deal, there isn't as much on the deal side. There's less value there. So I would take a smaller cut. And that's the way it should be. It shouldn't just be 50-50 all the time. From a cash flow perspective, the way that I do things is we take 15% of gross. Now, we only do that because we're a property management company, and for legal reasons, we have to do that effectively, but it's not a property management. It is a property management fee, but at the same time, it's like a partnership. If you figure out 15% of gross, what it works out to is about 30% of net. So most people are taking 50% of net, we're taking like 30%. So the partnership model works really well. The investor gets about 75% of cash flow. That's great. When we're bringing in $2,000 a month in cash flow and the investor gets 1,500 of that, that's fantastic. But the thing that I can do in London that people can't do in many other markets is the upside, right? All that, not just appreciation, but forced arbitrage upside. We specialize in getting deals. That's the important piece. I'm not just buying MLS trash and spending money and renovating it. I'm focusing on buying smart, and buying smart is the most important thing. If the market crashes, if you have a downside recession, you want to have your interest protected. You want to be able to hold through that period and still be, still have equity. So that's really important, I think, to our joint venture partnership strategy and kind of what we're doing. So hope that answered your question. Brian, that was a good question about how we structure things. I don't think I talked about that. A couple of contracts is how we structure it. So the investor buys the property 100% in the average type of deal. They're 100% on title, and I'm taking a risk. I'm trusting that they're going to pay me out on sale. We sign management contracts that give us control of the property. So from day one, I pick the keys up from the lawyer's office. It's as if it's my property, but you own it as an investor. So that's sort of the way we play things. The investor owns the property on title, 100%. They provide the financing, 100%, the mortgage, etc., the cash to close it, and we provide everything else as if it's our own property. So I'll renovate it, I'll manage it, I'll put the tenants in it, all of that, and we include everything. So there's no extra fees or whatever. We bill out basically at cost on the renovations pretty well. So it's the loss leader is more than the management isn't where we make a lot of our money. It's in the appreciation contracts. That's where I make most of my money, is in the upside. The management's kind of break even. We get employees in there basically to run everything with right systems in place, and we don't make all that much money from that. So it really is most of the money on the upside. So I'm trying to deliver deals well below market value, and that's been the important piece, I think, to this business that most people aren't doing. A lot of REITs today, they just are buying whatever, buying crap. So it's being smart on the buy, and I've not lowered my targets for what I'm buying. I'm making sure everything cash flows extremely well in a worst case type scenario. And so that said, investors have certain preferences. Some investors come to me and say, Mike, I just want luxury student rentals. Mike, I just want regular student rentals. Mike, I just want multifam, duplex, triplex, fourplex, long-term tenants. Mike, I just want young professionals. I just want families. I want to do Airbnb, Mike. That's all I want. We do Airbnb, and we do have an Airbnb package. We rent out an Airbnb here in London, so we do that stuff too. Short-term rentals. I'm expanding now into senior care as well. The senior housing is a big market for the baby boomer generation, so there's some stuff coming with that as well. The different packages, different styles of property you can invest in. So I keep an eye out, and if I find a property that investor is looking for, got it in the back of my mind to call them. The more they remind me, the better, because we got like a dozen investors already and a bunch of people who are interested in investing too. So it's who would be the best fit for the deal. That's basically how I do it, and on first come, first serve basis. So that's sort of how we do. I literally buy the properties myself in my name. I put the deposit up to buy the property. I lock it up under contract. I have an assignability clause. So I bought the property, then I assign it over to the investor. That's how I do it. I control the deal from day one. I'm not going out with the investor and saying, let's go buy a property together. I control the deal. I bring the deal to them. I say, this is a good deal. Do you want in or not? That's sort of the way that I handle the model. So I control the deal flow from start to finish. And so it's basically my properties that I would buy for myself anyway. And like you saw in the Black Friday video, this wasn't a deal that couldn't be financed. And just stuff happens. Sometimes an investor can't close, so we bailed them out. I took the deal back from the investor. I signed it to the investor. The investor couldn't close because the seller was being really terrible and not letting the appraiser go through. It's long story short. We had to close. They wouldn't give us an extension for whatever reason. So we had to close in cash, right? Quick close. So we had to borrow the money and close in cash, or just close in cash. And that's an example where every property I buy, I need to make sure that I would buy it for myself. Because at the end of the day, I may end up closing on this property. So that's the standard. That's the bar that I'm at. I'm not just buying crap for people. Because at the end of the day, if stuff goes south, I need to be making sure I would buy this property myself. And so that's the standard I use when I buy deals, is what would Mike buy? That's it. Hopefully that answered it. Nova Scotia is a great market from what I'm hearing. Yeah, I've heard decent things too. I think it's used to be tied very heavily to fishing and a few different specific industries. So you have to be a little bit more careful about that, similar to like a Sarnia tied to Chemical Valley. Whereas, London, you have more diversity. Toronto, you have more diversity. Vancouver, you have some more diversity. So just be careful. Some of those cities, if we had something happen where the waters got poisoned or something, and all the fish died, that market would be really not doing so well. So something to consider. And risk factors. I'm just trying to play the devil's advocate. Risk factor when you're investing in a city. Make sure you've got kind of a risk contingency plan outlaid from the beginning. So yeah, great points, everyone. Tyler Parks, hi, I'm #1 fan here. Tyler, thank you so much. That's awesome. I appreciate that so much. Thank you. And if you haven't already, guys, smash that like button, share this video around. I'd really appreciate it. We talk in the Wise Well Show about how to quit your day job. That's what it all comes down to at the end of the day. That's why we love real estate, because it makes us a lot of money. That's why we love personal finance, because it helps us control our financial future. And at the end of the day, once you've mastered your money, it's not about the money at all. It's about the lifestyle. It's about the freedom to do what you want to do with your life. So that's what it's all about. Brian Smith, he made a video on how he structures joint venture partnership on his channel. Yeah, Michael, great point. Where I talk a little bit about how to structure it. Now I've talked specifically about how we structure it in our company. So yeah, you got kind of an idea now, I think. Jason, how you doing, Jason? Is it worth spending a bit more on student rentals, ones that are really close to the university or college? Jason, great point. It can be. It definitely can be. You can get a higher rents than you would normally. And on our deal that we're joint ventured on, that one's kind of far from Fanshawe, but we could actually target Fanshawe students for that property. Believe it or not, we do actually already have targeted Fanshawe students for this property. So once we can get tenants out, this tenant's been really bad on the main floor. I don't know what we're gonna do with this property. It's really quite a challenge. Some tenants out there dig their claws and their feet in. They just want to fight. They don't want to work with you. They don't want to leave. They know they can't find rent anywhere else for as cheap as they have it now. They won't even take money. And so it's really tricky to get some of these tenants out. And at the end of the day, you sometimes just have to bribe them to leave because it adds so much value. Having that scumbag tenant out of the property adds so much value to the property. So at the end of the day, that's huge. Okay. Let's get the next question. When you collect rent, Michael Chung says, when you collect rent, does that money go directly into your high interest savings or investment accounts? No. I have float accounts. So it depends if it's my property or if it's investor's property. Sometimes we forward the rent. Literally, we'll collect the rent under our email. So we are the ones collecting the rent, and then we'll forward that rent directly to the investor, or we'll deposit in our commercial bank accounts for each property. And then we run the expenses out, and then we send the net every month or every quarter, depending on what the investor is interested in, every year. Some investors want it monthly, some want it every year. And we basically send out transfers or direct deposit. We set up a automatic transfer to their account. So that's sort of how we pay our investors. If it's my personal, I have a bank account for each property of mine that's I personally own, and rents that come in there, they sit in there in my slush account. If there's too much in the slush, let's say it's over a couple grand, I'll take that and move that into a high interest savings account, and then eventually move it into an investment account if I don't need it. Depends on your liquidity needs. Do you have high liquidity, low liquidity? Depends on your IPS, your investor profile statement. What kind of risk tolerance do you have? Some people are very conservative, and they want to. I used to take all that capital for a while when I don't have any lines of credit debt anymore, but I used to have unsecured debt that I used to buy properties for zero down. Like the down payment was coming from an unsecured line of credit. So I had a huge line of credit at like 6% back in the day, and I used to dump all the cash on that line of credit. And so all my cash just sat on this line of credit. And if I needed something to pay a bill, I would just take money out of my line of credit. And so I'd park like $20,000 on the line of credit to save myself that 6%. So if you have a line of credit that's got drawn down, why not put some cash on that to pay it down? You get a guaranteed tax-free rate of return that's equivalent to at least whatever your interest rate is. So if it's prime, it's 4.5%. Could be higher, I don't know. Could be paying prime plus. A lot of people are. Some people pay prime minus, which is fantastic. Michael Chung, when you collect rent, does that money go directly into your high interest savings account? I just answered that question. Sorry. Yeah, so it goes into the account, and then from there either goes on the line of credit or into a high interest savings account. Tiger Rocks, is there paperwork involved in closing in cash? A lot less than a mortgage. It's a lot easier to close in cash than it is to close a mortgage. Cash, I just take my cash, I bring it to a lawyer, it's done. It closes. You don't even need insurance to close. If you close a mortgage, you need to have insurance in place, fire insurance minimum in place for the mortgage, you register on the property. You know, there's a whole bunch of things. You have to go into the lawyers and sign those documents to review what the lender's proposing from terms and conditions standpoint. There's a lot more paperwork with a mortgage on a property than closing in cash. If you're to close in cash with a lender, so you get an unsecured loan or a secured loan, I guess closing in cash means you have no mortgage on the property, so it'd be an unsecured loan against the property. I'd say 12% or 15%. You would do a promissory note. So your lawyer would drop a promissory note, or I would drop a promissory note. Me and the lender would basically sign something saying, hey, they're lending me for X term, I'm going to pay them back X amount of interest, and that's it. Yeah. Sorry, I wasn't clear. What I meant are the most important things you're looking for when looking for a good real estate deal. Okay. So you're clarifying that question earlier, Snake Eyes 11, or SGTSNAIs 11. Great name. I love the troll avatar that you have there. Internet troll. What do you look for in a good deal? Cash flow first and foremost. So minimum 1% rule, ideally closer to 1.5% rule still in London, totally possible. So on a $217,000 purchase price, we can get $3,000 a month in rent. That's right about where you want to be. Another deal like, $350,000 purchase price, we want around $4,000 a month in rent. Typically is kind of the goal at a minimum on a conservative side. Now you could do luxury rentals or Airbnb, short-term rentals and get more, but you want to be conservative and make sure your property cash flows, even if that strategy doesn't work anymore. So that's kind of where, when I'm looking for a deal, it starts with cash flow, but it also looks, I just know market value. So if I see a deal, it's like 150 grand for a property, and I know that the property should be worth 200, I'll jump on that. So it depends on if there's upside. Just knowing your comps and knowing your values of properties is important. And then of course, always buying property that can cash flow, really important. I don't do a lot of speculative plays, but some people do, and they do all right with speculative plays, especially in this market we're in right now where it's so hot. Yeah. Tiger Rocks, what bank do you use? I use every single bank. My favorite bank for actual day-to-day banking, like I've had mortgages at TD, Scotia, CIBC, BMO, name it. Not RBC. For some reason, not RBC, but they're great. They all do residential mortgages up to 6 units instead of up to 4. All the rest of the banks do up to 4. So you can buy 5 or 6 plexes and have residential financing. So RBC is fantastic for that. I've just never had the opportunity to buy a property like that where I needed to finance it. So RBC is fantastic. But Bank of Montreal, BMO, is who I use for my day-to-day banking. Mostly, although I have a couple other banks too, Scotiabank and a few other places. Something cool about BMO is under one lead account, you keep minimum $5,000 or $6,000. You get unlimited bank drafts, unlimited everything, no fees, unlimited e-transfers, unlimited everything. And you get 19 other checking accounts tied to that same account for free. So that's great for joint venture partnerships or tracking different properties. Most banks will require you to keep a minimum balance in each and every account. I have one lead account and I get 20 different accounts linked to my bank card, and I'll put partners on those properties. So I'll have my JV partner on the bank account, and basically it will be 50-50 on the bank account or whatever, and he'll get a bank card, just access to that one account, and my bank card will have access to all 20 accounts, which is fantastic because if I go to TD or somewhere else, they're going to make me have a minimum balance or a monthly plan fee, because I have no monthly plan fee, 100% free. On the commercial side, we have to pay for e-transfers and there's tons of fees, but on the personal side, it's totally great. We don't pay really any fees, and that's been a huge win. So people who are looking to do joint venture partnerships, I recommend Bank of Montreal. Looking to buy a few properties, Bank of Montreal, again, fantastic for that because they do allow the multiple accounts for free. So that's a huge one. Jonas, how did you enjoy speaking at Ivy? Jonas, I loved it. It was so fun. I got so amped up. I'm so tired today though because I've been networking and talking to people all day, and I was up really late last night. So I'm going to end this stream at 8 o'clock. Apologies ahead of time for that. It's going to be a 1-hour stream today. I'm exhausted, and I have so much work to catch up on. I need a protege. Like I need to do a video on getting a protege. I need someone that's like super loyal, super committed, that wants it on the ground floor of what's going to be $1 billion company. And I kid you not, $1 billion company. Who's going to learn a lot of really cool things, but I need someone that's going to be just there, basically living here, living in the house and just learning and everything. The person needs to be super smart. They need to be super quick. So it's going to be difficult to find that perfect person, but I know that person's out there. The person needs to be me, basically, to do a lot of what I do. There's probably 20% that I just can't get to in every single task, from bookkeeping to renovations to just all these little things that I just can't keep up with on a daily basis. And I just need someone that I can train to become basically me, but that isn't going to compete against me. This is the challenge. So if I train someone to be as good as me, I think I just do exactly what I'm doing and compete against me in the market. This is the challenge. So I love teaching and I love giving away. I do that on YouTube, and I'm happy to mentor people. Tons of people come and shadow me, and that's cool too. But I just need to find that right person and build that A team too. So at the end of the day, I would love to have our back boardroom filled with 10 of the brightest minds. We're trying to start a wholesaling company here. We're trying to start many different divisions, and I want to bring people into the business. And so blow it up, blow up the A team. So that's something that's really top of mind for me right now. I don't know how I got on that tangent, but somehow I got on that tangent. I think Ivy was a good place to speak. There's a lot of smart kids there, and I don't know if they'd want to work for a startup, but I think there definitely is an opportunity there for the right person. So, and maybe they're not an Ivy student. Maybe they're just a regular person who wants to learn. I think it's more important the person is extremely smart and really hardworking than it is that they know about real estate. Because I can teach you everything you need to know about real estate. I didn't even know how to swing a hammer when I started this. So it can all be learned. But that's kind of where I'm at. The team will make the dream. I like that. It's a good one, Jonas. Great one, actually. Very, very true. So I love speaking at Ivy today, and I met some great people. I think there's some people at Ivy who have capital, and they're not doing a very good job of managing that capital. And so we could bring optimization to their portfolio. And if they have capital they want to invest in London, that's great for us. It's a win-win, helps us grow. We, of course, always need more investors to satiate the demand for deals that I'm bringing in, because I got a couple deals I'm locking up right now, and I don't know for sure if I have an investor for them. So that's something I got to kind of rationalize and figure out. Hugo C says, has the big owner of commercial real estate in London approached you yet? I think it's Farhi. No, Farhi hasn't approached me yet. Farhi, if someone knows Farhi, reach out. Shmur Farhi, reach out. If he has some real estate holdings that he wants to get rid of, some apartment buildings or something that he wants to offload, I guarantee you I can put together an offer to take a couple hundred of his units. I have some investors, we could put some together. So if someone knows him, I should really reach out. Once I'm an agent, I'll probably reach out to him and just let him know, right? And get into having those conversations with those people. There are a few, like the Ivy family here. There's like 10 families here that own a lot of the real estate in London. So no one's approached me yet. I'm a small fry. I honestly am. 10 figures is nothing. Those people have $1 billion in real estate holdings, right? So 10-figure real estate portfolio is nothing. $10 million is not a lot in real estate. Even 25 million isn't a lot. You need to have 100 million to really have any impact. So we have a long ways to grow, but I think we're gonna do that the next year and a half. That's the goal. We're gonna get huge fast. What that means is I'm gonna make investors tens of millions of dollars in the process, because every dollar I make, they make like $1.50, right? So the investor's making more than I am. Think of all the money everyone's gonna make. It's gonna be fun. Even if we have a market correction, in fact, I hope we have a market correction, because that's when the deals come out. That's when we double down, right? Most people get afraid in times of recession and pull away. But we look at the data. We know that Canada's the third most, in the top 3 for the most desirable places to live in the world. So as long as Canada remains a place people want to live, real estate in Canada is going to be doing fairly well. Net migration, so population is growing faster than it has in the last 6 decades. Look at some of the data on that. That's fantastic news for a place like London. That means rents are going to continue to grow. If rents grow, real estate can do nothing but grow. Even if interest rates rise, we still can cash flow like at 6 and 7 and 8% interest rates. So even though prime's 4.5, we're getting mortgages at 3.89, 3.99 now, whereas I was getting them at 2.5, a couple years ago. We still cash flow. There's still enough margin that things make sense. So at the end of the day, I like the interest rates are rising. What it's doing is separating the boys from the men. And a lot of people buying properties that cash flow, like the Keyspire model, 100 or 200 bucks a door. Those guys are going to suffer in a recession, but we're going to be fine. We're buying smart. Power saturate, I'll give it like 5-10 more minutes. Okay. Do you prefer refi over HELOC? I prefer refi over HELOC. So I think what you mean, Michael Chung, is putting another mortgage on the property and I'm removing the first mortgage and putting another first mortgage on and getting paid the difference between what your old first mortgage was and your new first mortgage that you're registering on the property. That's way better. Reason for that is it's directly write-offable. HELOC, you have to do the Smith maneuver to ensure that you can write off that interest. The other thing is too, interestingly, your credit score isn't affected by a mortgage being put on, but if you max out a line of credit or a HELOC, it negatively affects your credit score. So it's actually better for your credit score to put a mortgage on. Also, HELOCs are more expensive than mortgages. You can fix in a 5-year fixed mortgage at 3.79, but your HELOC will be at 4.79 or 4.5 or something, right? So the interest rates are way cheaper on fixed in mortgages. So I would always refi over HELOC. That's just my preference, and it just makes more economic sense. But each person is different, and in certain circumstances, it can make sense to have a HELOC instead. And so there's not always one answer, and it does depend. I've talked in situations with people where it made sense. So have you used accelerated mortgage paydown? It's like you use PLC and make a lump sum payment and pay that and track your mortgage as a savings account and PLC as a checking account. Yeah, I've heard like the all-in-one mortgage accounts and you can do really accelerated payments. I actually don't like paying down debt. You don't want to pay down really cheap, good debt. If you have debt at 3% or 3.5% or 4% below prime, why would you want to pay that down? You want to be as levered as you possibly can. If you've paid down half your property or a third of your property, go back to the bank, get a mortgage, refinance that property, pull that capital out and buy another property. Your capital could be working way harder for you. If it's sitting in your property, it's saving you your mortgage interest rate. That's it. So if your mortgage interest rate is 3.5%, you're in a 3.5% rate of return. I don't know about you guys, but my down payments are getting me 25 to 45% rate of return. 3.5% is nothing. I'd rather have 5 properties with 20% down on each one than have 1 property paid off. The same amount of money. It's going to cost you 200 grand to buy 1 house in cash. It's going to cost you 200 grand to buy 5 $200,000 houses at 20% down, or $1 million in real estate. I'd much rather control $1 million. So as you pay down property, you want to actually remortgage that property out every 2 to 5 years. I refinance. So I pull the capital out. I don't ever want to pay down a mortgage. Paying down your mortgage is a bad idea. Check out the video I did on that and why I think paying down your mortgage is a bad idea. But great question. What is the maximum number of investors you have in one property? 1. I almost always have 1 investor and ourselves. It's just way cleaner, way less issues. Now, big deals, I might put 2 or 3 people together on a thing, and we'll buy an apartment building in a corp. That's where it makes sense to buy in corps. Otherwise, it makes sense to buy personally. It makes no sense to buy in corps unless it's bigger type deals. That's not true. Sorry. We have one property where someone brought the financing and someone brought the capital, and we're the partner, I guess. So 3 is the most partners I've ever seen on. Just you don't want to split that much. Like there's only so much profit. If you're bringing in $1,500, $2,000 a month on a property, you start splitting it too many ways. It doesn't make any sense anymore. So, if we can work with one investor, it's a lot easier and there's more cash flow for everyone else. So might as well just do big deals if you want to bring a lot of people together on one deal. That's my thoughts. Okay, rapid fire round. I'm going to keep going faster. Tiger Rock says, thank you. You're welcome. Thanks for answering all our questions. No problem. Red flags when looking at your credit report. TransUnion versus Equifax. I don't know what the question is regarding that. So red flags would be if you ever missed a bill payment, you paid late. If you've used more than 30 to 35% of your available credit. So if you have $100,000 in available credit, you use more than 35,000 of that. And I'm talking mortgages. I'm talking unsecured credit, like lines of credit, HELOCs, credit cards, that sort of stuff. If you have one credit card that it's got a $1,000 limit, you've put $800 in purchases on that, it's 80% utilized, that'd be a bad thing. Obviously, default things into collections, huge red flags. Check out those 2 videos I did on the credit score, but definitely there are red flags. Be smart, be good, repay your debts. I always say a Rosehart always repays its debts like a Lannister. If you guys watch Game of Thrones, a Lannister always pays their debts. Rosehart always pays his debts, no matter what, always. And I live by that. Like if I didn't pay a debt, that would be terrible. I would work day and night to ensure someone was paid back. It's very, very important to always pay your debts and always pay your debts on time. I understand if things happen and you forget or whatever to pay a contractor or something. But at the end of the day, if the person reaches out, you should pay them. You should not pay people. It's not a good thing to do. The team will make the dream. You're baked potatoes to us. Aw, thank you. Appreciate that. Is Quebec included in that? I believe so. I'm not sure what that's relating to, but Michael Chung says, get some rest. Thanks, Mike. Nico, thanks. No problem. And fist bump. Thank you. Appreciate that. It is now 8:01. So with that, we're going to wrap up the Wise Wealth Show. Thank you so much for tuning in. I hope the quality came to you guys fairly good. We've been trying some different settings. Next time you see me, next Wednesday, for the next live stream, hopefully this bad boy will be gone. You can't even probably see it because I have the smooth filter on camera, but this will be gone. It'll be fantastic to have this gone. Thank you so much, everyone, for tuning in. If you're watching still an hour into this program or towards the end of this Wise Wealth Show, I want to see that like. If you're new to my channel, welcome to my channel. Check out some of my cool new videos. I'm getting better every day. I'm dropping better content, more succinct, better editing, better quality audio and video. And so welcome to the journey. I'm going to share with you what I know. I'm going to bring the experience of my life to you guys in the hope that you can learn something from the failures that I continue to make as an entrepreneur. I fail and I learn from it. And that's the important thing at the end of the day, is that you learn something from it too. So smash that like button, jump in the comments, throw your question up there if you have one. I'll always try to answer the comments until I get so big that I can't, and then I have to get someone else to answer the comments for me. But currently, we're almost 3,000 subs, 2,900 and something. We should cross 3,000 subs by next week, hopefully, fingers crossed. So that'd be really cool if we get 3,000 subscribers, and the channel is doing really, really well, and things are going really great with that. So thank you all so much. I wouldn't be able to do this today if it wasn't for you. So thank you so much, all of you, for supporting me on this journey, subscribing to the channel, and of course, sharing those videos with your friends and family and commenting on the videos, because interaction is really, really important to YouTube's algorithm of making the video go viral or having it show up in a playlist. If you watch the ads, if you let the videos run all the way through, that adds a lot of value to me, right? I don't make a lot I make a couple cents if you watch an ad, so it doesn't really impact the bottom line, but it really does allow YouTube's algorithm to promote it. If you watch those algorithms, if you keep on the video all the way through and you click onto my next video, at the end of the video, you click on those recommended videos, that YouTube loves that. They promote it, they put it in the algorithm, and people find this. People find financial independence, and they get out there and they learn something. So it's really, really important that you do that. You're actually helping your fellow man find fire. So that's what I have to say for today. You guys know there's 3 levers to unlock a wealthier you. You need to spend less, you need to earn more, you need to maximize your return in that order. Spending less is super important in the beginning of your journey. Earning basically the highest maximum ROI you can later on once you've built up some wealth, way more important than being frugal. But in the beginning, frugality is the way you build capital, by trying to get that gap between what you're earning and what you're spending as big as you possibly can, and then start the snowball rolling. Once the snowball is rolling, then it's, of course, really important how fast that snowball rolls, or the ROI. So spend less, earn more, and maximize returns to unlock a wealthier you. Thank you, everyone. YOLO Fire, how's it going? LEC, Jason, Mr. Michael, Tiger Rocks, Andrew Howe. Thank you guys all for joining in, and I look forward to seeing you guys next week for the Wise Wealth Show, episode 27 next week. Bye, guys. Stop recording. Bye, everyone.